Happy Friday Eve, live from Studio 2 at Bloomberg headquarters in New York. I'm Scarlett Fu.
I'm Alex Steele. You took my line.
I know,
that's
I'm sorry.
Why we're
I got
kind
excited.
of the same person. It's, at the end of the day, that's what that is. All right, we're trading a little heavy right here in the U.S. for the equity market, but I gotta say, like, not a lot of momentum either way. The S&P just up by about 0.4%. Now, the worst performing stock within the S&P is Lennar. After earnings, they released them yesterday, but really it was about the margin outlook, the gross margin outlook for the second quarter. We're going to speak to the CEO in just about 10 minutes' time. 10-year yield. This is where the action is, the back end of the curve. If you're going to push out rates for longer, that's going to wind up hurting growth down the road. That's the theory, therefore higher yields in the long end. We also triggered a big move kind of above all the moving averages for the 10-year, so watch any sort of buying/selling that comes into that because of the technical issues. And Bloomberg Dollar Index up by 0.4%. A pretty solid move here. Biggest rally in more than a month, Scarlett. Also, Barclays coming out saying Bloomberg Dollar Index could rise 3% if President Donald Trump is reelected. We're in that place now.
Yeah, we're definitely in that place now. All right, well, today's data drop, let's talk about that because it does reinforce the Fed's lack of action. The takeaway from a hotter PPI and cooler retail sales prints is that inflation looks sticky even as consumer spending is slowing down. So does this change the Fed's timing on rate cuts? Does this derail the stock market's rally? For now, the answer to both is not yet. And Alex, you mentioned housing and Lennar. The co-CEO of Lennar joins the close to discuss what demand for new homes looks like this spring selling season. Also in the next hour, the potential crisis that is brewing in uninsurable U.S. homes in regions that are at risk of wildfires and hurricanes. We're talking, of course, California and Florida. But let's return to the markets right now with stocks and both bonds showing a bit of weakness today. Alex, it really renews the debate over whether certain assets are in a bubble.
Yeah, and I love that you set it up like that, because if you take a look at what the Fed's going to do, what the market expects the Fed going to do in stocks, they don't care. This is a great chart that shows WIRP. That's the white line. So that's the world implied rate probability for the Fed, and it's inverse. So the higher it goes, the more cuts to expect. The lower the white line goes, the less cuts to expect. And we're now looking here at more restrictive policy, right? Because you're not going to get as many cuts. Now, the blue line here is the S&P. You can see them moving relatively in line over the past year. And then boom, right here in February, stocks continued to propel higher despite the fact that we're looking at higher Fed funds rate for the foreseeable future. So I don't get that, Scarlett. Like, at what point do high yields, and I mentioned the 10-year yield hitting some resistant levels here and breaking through those moving averages, does it affect stocks? Or does it not matter? Can we continue? And by the way, I should point out, it's not just tech here. It's overall. Even the equal weighted index isn't as terrible and not necessarily rolling over because of high yields.
Good point. And we'll put that question to our next guest. Let's kick things off with Jimmy Chang, CIO over at Rockefeller Global Family Office. Let's start where Alex left off. Yields are rising. They've been kind of stealthily moving higher, especially with the latest data prints. What does that tell you about where we are with equities? At what point does it start to have an impact?
Yeah, it's interesting that if you look at last year from end of July, early August to end of October, there was this inverse relationship between bond yields and the equity market. When yields moved higher, equities moved lower. And subsequently, since the start of November, you got that reversal. And that relationship is now broken. Mm-hmm. And that's because I think at any one time, the market tries to find a few catalysts to focus on. And right now, the focus is AI, is NVIDIA. It's no longer what the rates, how it will move, with the assumption that the Fed's got your back. At some point, they will initiate rate cuts. So in a way, the market is still just celebrating the supposed soft landing or even no landing. And in the meantime, assuming that despite the bumpy ride in inflation, the direction is still towards that 2% at some point later this year.
Okay, so good news is good news, bad news is good news. Without being alarmist, though, when you look at today's data drop, it raises some uncomfortable questions about whether we're headed towards stagflation. Do you think that's the case?
Indeed, when you look at today's data, with the retail sales being somewhat weaker than expected and the PPI higher than expected, that paints a photo of stagflation. My view is that stagflation will be transitory. If we do run into that environment, there's a way to bring inflation down. Unfortunately, the cost will be a tighter Fed, an eventual, perhaps a mild recession to bring the pricing pressure down. I don't think that's a base case for the market right now, but I do think there is that risk with the Fed having pivoted perhaps too early back in mid-December And everything has a feedback loop. By pivoting too early, it rekindles the animal spirit, and you get gold, bitcoins, equities, all at all-time highs. I mean, this environment is difficult to cut rates. I mean, imagine you start cutting rates soon, you just pour fuel on fire, and this thing, could go even higher, and that's inflationary.
Right. It's like, how much can they cut before inflation is actually stoked, right? Okay, so put that all together for us. Is tech in a bubble, if we narrow it down?
I would say pockets of the sector feels bubbly. The issue is whether we call it a bubble or not. It's not a timing indicator. It probably means in the long run, it's not going to work out too well for many of the stocks. In the short run, are we in, January 2000 era or June 99, or are we close to that March 2000 peak? If you use the dot-com bubble as an analogy, you just don't know. I think part of it is also due to the liquidity in the market. Surprisingly, we have been getting a stealth QE with the deficit being so doubly stimulative. So it's not only a traditional fiscal stimulus, it also released $2 trillion from the overnight reverse repo. That's where the excess liquidity is parked. And we had as much as $2.5 trillion in that facility at the start of 2023. Since then, given the massive amount of bill issuance, and 80% of our debt issuance now is in short-term bills. So that soaked up the liquidity, and that liquidity flew to the Treasury and recycled into the economy and the banking system. So it more than offset QT, and in fact injected liquidity, so the bank reserve has gone up 20% since the start of 2023.
Right, so do you think that the Fed's going to have to officially then stop QT if reserves fall to a certain level, and do we know what that level is yet?
That's a question. At what level is the Fed comfortable with the bank reserve, the minimum level? Some argue it could be $3 trillion. If that's the case, they may allow QT to run longer. Now, I do believe that the reverse repo could be depleted close to probably by year end this year. So beyond that point, if the Fed wants to hold the liquidity constant, they will stop QT. If they're willing to let the reserve run down some more, say towards $3 trillion, they could continue QT for another 6 months. So a lot depends on the Fed's own reading on that level, minimum level of bank reserves.
How much of the rally do you think liquidity is responsible for? You mentioned that there are certainly some narratives that people are picking up on, AI being one of them. But if it's liquidity, is that responsible for 80% of the market's gains, 60%?
Well, if you look at a simple rule of thumb, last year earnings grew about 4%, market went up 20+%. So PE expanded. So I would think a lot of that PE expansion was due to liquidity. You can also argue that sector-wise, because of AI, tech having higher, PE, so aggregate, PE also went higher. So I would say a lot of the, rise in the market was tied to the liquidity flow.
All right, and of course, easy come, easy go when it comes to liquidity. Jimmy, thank you so much. Jimmy Chang is CIO over at Rockefeller Global Family Office. We've got a lot to cover here on The Close coming up. The future of TikTok is in the hands of the U.S. Senate, so we'll take a look at the economic impact if the app is banned in the U.S. Seema Shah of Sensortower will be joining us.
All right, plus one of the highlights from today's Greenwich Economic Forum in Miami. Greenwich in Miami, sure. We're going to hear from Romaine's interview with Dina DiLorenzo, co-president of Guggenheim Investments, on how technology is reshaping the financial sector.
And we're going to talk housing. Stuart Miller, the co-CEO of Lennar, will be joining us following the Homebuilder's latest results and the outlook for the year ahead. Lennar, one of the worst performers in the S&P 500 today. This is The Close on Bloomberg.
All right, one stock we're watching today is Lennar. It is the worst performer within the S&P. There was some good, there's some bad on the earnings from yesterday. New home deliveries in the first quarter up 13%. It's the gross margin outlook, though, for the second quarter, current quarter, which fell short of estimates. Well, joining us now for more is Stuart Miller, the co-CEO of Lennar. Hey, Stuart, we really appreciate you joining us. Investors did not like that gross margin outlook for the second quarter, even though it's still double digits. Why the disappointment? What's behind the shrinking gross margin?
Well, I'm not sure that it's a disappointment. It's certainly not a disappointment to us. our strategy has been clear. There's a housing shortage in the country right now. It is well documented. Our view of our mission is to continue to produce homes, continue to build homes. As interest rates has fluctuated up and down, the American consumer has found itself up against the wall of affordability. And that means that people are having a tougher time qualifying for a mortgage as monthly payments go up because of interest rates. They're having a more difficult time because of inflation, saving the amount of money they need for a down payment. And that just means that our margins are going to get compressed as we move forward if we're going to meet the market where it actually is. Our view is America needs housing, and so we're going to continue producing homes, and we're going to sell where the market is. Now, on the brighter side of all of that, we continue to be intensely profitable and generating a tremendous amount of cash and capital. You look at the balance sheet is really strong and getting stronger. And so as we go through this next cycle of interest rates, figuring out where they're actually going to go, you're going to see our margins move up and down, and that's okay.
So, Stuart, I hear you that it wasn't disappointing for you guys, but the investors just didn't like it. You just have to look at the stock move. So I'm wondering why you think that it's volume versus margin protection is the right strategy right now in the environment that you just laid out.
Well, again, as I look ahead, you look over the next years, we have a housing shortage in the country. Volume is going to be what makes up that housing shortage. We need a healthier housing market for the country. And it's really the working class participants that are having the most difficulty finding attainable housing. And it's our mission to continue to produce at the price where affordability meets need. So that's what we're doing.
That makes sense. Your outlook for this quarter, according to analysts, suggests that you may be easing off of incentives. Do you worry that home buyers have grown too reliant on incentives like mortgage buydowns in the way that shoppers won't go into a store and buy anything unless it's 20, 30, 40% off?
80%.
80% for Alex.
So I don't think it's philosophical. I think it's practical. I think it comes down to how much home can somebody afford, and it really comes down to that monthly payment, and the monthly payment is a derivative of the interest rate. So I don't think that they've become accustomed to the incentives or the buy downs. I think it's a practical reality that in order to make housing affordable, people have to be able to afford a down payment. They've got to be able to qualify for a mortgage, and that mortgage is going to be defined by the mortgage payment, which is interest rate centric.
Okay, so there's mortgage buy downs, there's other financial incentives, but I'm curious as to how you address affordability when it comes to your actual product. Do you have smaller square footage homes given this current environment, fewer amenities inside the homes, maybe lower grade marble kitchen counters, for instance?
Yeah, it's all of the above. I mean, when affordability is in the crosshairs of what makes the market be able to meet need, you have to start looking at everything. You have to start looking at square footage. You have to start looking at inclusions. You have to start value engineering every component of the home, which means making compromises not in quality, but in the way that you actually configure homes. So at the end of the day, we have been doing that over the past couple of years to meet the market where it needs to be met in order to make for people to be able to have shelter.
Stuart, this might be a really silly question, but what is the exact correlation to mortgage rates when they're 6-something versus 7-something versus 8? Like, I'm trying to get a sense of what mortgage rate on the 30-year fix do you wind up seeing kind of a flood of demand?
Well, let's go to the outer boundary. As we started to get to 7.5 and towards 8%, we really felt the market, flutter a little bit and get really swirly. As we start moving back down to 7, 6 3/4, 6.5, it's kind of like we've reached somewhat of a new normal. The market starts to get a little bit more activated as you get down to 6.5. When you ask the question about flood of demand, I think you're going to have to get down to 5.5 and 5. And that's where you really start to activate the existing home market to start contributing and start bringing product online as well.
So one thing that has helped you and other home builders is the lack of competitive supply, certainly in the resale market. But we're starting to see that shift a little bit, especially in markets like Florida. And I'm curious how this affects demand for your product in those kinds of markets.
So always remember that when the resale market brings product online, the person that is selling also is a buyer. So it's almost, in my mind, a net zero. The seller is looking for another home, generally a move-up home or a move-down home. And therefore, it's really only the new home market that is adding inventory, real inventory, to the equation.
When you talk about your asset-light model, though, as Scarlett was pointing out, that you announced you're going to look to spin off your own land into a new vehicle. I mean, I get the idea, but I'm curious as to the timing. Like, why does right now make sense?
So this is a continuation of a program that we've had in place now for the past 5 years. And basically, we've been moving land into off-balance sheet vehicles that are basically option-driven, where we're buying land just like we're buying refrigerators or buying lumber on a just-in-time basis. This is more of a manufacturing model. The spinoff that we're looking at today is just like some of the structures that we're already using to provide that just-in-time delivery system. This will be, as we have it stood up right now, a permanent capital vehicle, which enables us to have more certainty as to where capital will come from and how available it is as the market moves upward and downward.
That makes a lot of sense. I'm curious because I know in recent years, Lennar has floated an idea to spin off the multifamily operations. Is that still a possibility?
Not likely. We walked past that idea as capital markets really changed for commercial properties, including apartment. That change in market condition really put that on, kind of put it in cold storage. And I don't see that market coming back in the near future. So it's a very different concept this time around. The spinoff of the commercial side of our business is something that we've stopped. This is purely focused on land, and particularly land that will be optioned back to the company.
All right, fantastic to get your take, and thank you so much for joining us today to give us some insight into what you see for the housing market in the coming months. Stuart Miller is co-CEO of Lennar. I don't know about you, but for a while it was a big deal to just go into these new homes that were newly constructed and just check out the amenities and, you know, imagine that I actually live there.
Is that where the marble courts thing came in?
Yes.
Yeah,
yes,
okay.
Exactly.
I was like, that was very specific that you have that. But, you know, when we talked about a place like Lennar, it just, like, we had this conversation that, like, I'm part of the problem. Like, I have a 2.75% 30-year fix.
Yeah, and you're like, I'm not giving that up.
I'm never leaving. Like, I can't. And there's so many people like me. And because of that, that becomes really good news for Lennar. But the affordability issue is a problem. And then if they address that in different ways, hence the margin compression. So, sorry?
Your daughter will be looking at that house that you have right now in years, right?
She's going to sell that puppy.
Okay, coming up, we've got a lot more to come on the close. We're going to talk about Adobe because cloud revenue and AI may have driven Adobe sales in the first quarter. And of course, the company will be reporting earnings after the closing bell. We're going to get you a preview. This is the close.
All right, time now for top calls. We'll look at some of the big movers on the back of analyst recommendations. First up, we get Robinhood. So Bernstein initiating coverage of the stock, rating it outperform the $30 price target. Crypto assets are currently valued about $2.6 trillion today. And Bernstein says that the number can triple by 2025. And for investors looking to ride that wave of this monster of a crypto cycle, he says now is the best time to enter Robinhood. Those shares are up almost 5%. All right, next up, Under Armour's rating a cut to underperform from Inline over at Evercore ISI. Founder Kevin Plank is going to return to the sportswear company as CEO. He's going to replace Stephanie Linnars, who joined last February. Evercore says that it is a clear signal the strategy is not working, and Plank's approach to the focus will likely be on North America and could add significant risk to the brand longer term. That stock down double digits, over 10%. And finally, we get Oracle upgraded to buy from hold over at Argus after posting strong third quarter results earlier this week. Analyst Joe Boner cites positive results trends around cloud revenue. He expects this to become an even bigger driver of Oracle's total revenue in the coming quarters. He says the price target at about $145. And those are some of our top calls. All right, let's stay with software for a moment. We're about 40 minutes away from Adobe's first quarter report. AI going to be a top focus for investors, partly for Adobe's integration of AI in its suite of products, and partly for the risk posed by competitor OpenAI. Joining us now for more is Brent Bracelin, co-head of technology research and senior research analyst over at Piper Sandler. He has an overweight rating on the shares. All right, what are you expecting come 4 o'clock?
Come 4 o'clock, I do think we'll get an update relative to the momentum in the business. We think it actually could be better than feared. The stock has kind of had a little bit of a run ahead of earnings. If I look at the broader software space, the typical software company in my group is actually down about 3% on average on earnings. So earnings hasn't been a positive catalyst for the group, but we think the story around Adobe is numbers are healthy here. It's a $20 billion revenue run rate business, 46% plus operating margins. They're going to generate over $8 billion in cash flow this year. We think that could grow to about $10 billion a year in cash flow over the next couple of years. So a really solid company. The debate why the stock was down year to date going into earnings is really around the risk around AI, the opportunity. We've had a lot of controversy a year ago on Adobe, where Midjourney and Stability AI, these image generation competitors, were coming to market. There was a fear that could erode some of Adobe's business in the years to come. They actually responded. They came out with a new, their own Firefly image generation tools, embedded that in the workflow, and you saw a very strong performance at Adobe. In the last month, we now have new AI threats with Sora and OpenAI and video generation technology now driving a new concern. How does this impact Adobe?
Yeah.
We think last year those fears are overdone, and you're going to see Adobe talk about some new things they're doing with AI that could change things.
Okay, and I know that you're referring to an Adobe Summit user event that's coming up later this month, March 26th. And part of the excitement for that is because Adobe has this built-in user base, freemium model where there are 600 million plus users that use Adobe but don't pay for it. How does that work with the kind of AI initiatives it's got planned?
I think it's a great question. If you think about a competitor to Adobe at the low end of the marketplace, a company called Canva. People get really excited because Canva has 100 million, 130 million monthly active users that are using their product for free, and they're converting those free users into paid users, a new monetization opportunity. Adobe, a lot of people focus on their creative professionals. They have about over 30 million creative pros paying Adobe. These are professionals that are experts in that field. But there's a debate. Can Adobe go after the lower end of the marketplace? Well, they have 600 million free Acrobat users, very large base of folks that are interfacing using Adobe's products for free. They're coming out with a new AI assistant that's going to allow you basically to now create a whole new monetization vector over time for a large premium base of users that they haven't really monetized yet over the last 15, 20 years.
Hey, Brent, did Kate Middleton use Adobe? No, I'm joking, but what I'm trying to be like is when regular people come in, then they're going to want to pay to get the good stuff, right? If you're going to crop a picture or pretend it's a real picture, we want the good stuff. Do they have the good stuff?
I think Adobe's been slow. Full disclosure, I think they were slow to addressing the lower end of the creative market. They were very focused on what they were good at, supporting creative professionals. The non-professional market, I think, is where they missed the mark. They were late to market with some functionality there. They're playing catch up and they're moving very quickly. So yeah, think of Adobe as a dark horse in that non-professional creative market where they haven't participated. They're going to bring professional quality tools to the non-professional. I think you'll see that over the next couple of years.
Alex, we know it's not Kate who did it. It's someone in the palace.
Totally
Kate doesn't do her own
Yeah,
photo
100%.
editing. So
she would have done a better job.
yeah. Anyway,
Point taken. Low end of the market needs to have better stuff.
Yes. Brent, I got to ask you about what's going to happen with the money that Adobe set aside for the Figma deal. It was supposed to be a $20 billion transaction. That did not go through. So now it's got some capital to play with. Could Adobe, I don't know, issue its first dividend? Is it going to buy back stock? What is it going to use that cash for?
We hope to get an update tonight. If not tonight, maybe at their user summit financial analyst day in a couple of weeks. The point here is that they have a lot of cash. They're not going to spend $20 billion to buy a company. Regulatory pressures kind of limited that opportunity.
Right.
And so, yes, I think there is a portion of shareholder base is looking for what will you do, what's the priority now if Figma is not a priority, and it could be a dividend, it could be a buyback. We'll soon find out.
All right, Brent, thanks a lot. We really appreciate it. Brent Bracelin over at Piper Sandler. But I was also reading up about it, and the whole idea of using AI from like text to video or text to image, that's kind of mind-blowing.
I know. I haven't really experimented with this. I think I'm kind of scared to get into that whole, like you go down a rabbit hole very quickly.
Yeah, no, but I think that's the kind of the point. Like if Adobe can get people like us, and by us I mean we got kids, we're busy, we don't have time, we don't care.
The low-grade users?
Yeah, exactly. I can barely like do the filter on my camera if I remember. Like if you get people like us interested, that's a different story.
And get us to pay, right?
Oh,
that's an untapped market, huge market.
Huge. All right, well, we're here, but Romain Bostic, our co-anchor, has had a very busy day for the Greenwich Economic Forum in Miami. He interviewed some of the top names in finance, and one of them was Dina DiLorenzo, co-president of Guggenheim Investments. Romain asked her how technology is changing the finance sector.
The shift is, how do you deploy technology? And we are really clear about the whole technological aspect that we want to bring in technology that will provide our people with more efficiency, right? Our greatest asset are our people, our human capital. And so I'm looking, as I was the COO, now I'm the co-president, but we're always looking at innovative ways to apply technology into our organization. And about 5 years ago, I went on a mission to cleanse and unify the data in the cloud. And I'm really happy that we did that because we have a very strong data governance. So we're really poised right now to deploy some really interesting technology to arm our, not just on the investment side, but from our client service side, legal compliance, operations, in a way that allows us to be more responsive to our clients and to our employees, right?
So when you say clean up the data, is that to make it more searchable, to make it more
consistent?
Okay.
It's more about, we built data dictionaries, so the data itself was cleansed. It was just sometimes the way you tag the data, and so therefore, and I think that's something that people need to be really careful about when they start to bring on technology, especially artificial intelligence, because you want your data to be your data. We looked at a variety of different options to outsource data governance. And at the end of the day, we decided it's our data. We want to be responsible for it, but we'd love to outsource applications with firms that are really sophisticated in fintech, to continue to leverage off that data and be more expeditious in getting the results.
How hard was it to do that on your own, though?
Oh, we were great. We created working groups, and I'm a big believer in the working groups because that brings a variety of people, multi-generational and cross-functional. So we had a lot of fun with it. It was hard work, but it was great because it was during COVID. So it really allowed people to stay engaged and talk to each other and get to know each other, even though they were in different functional groups and not seeing each other. So it was a great project. And we just deployed phase 1 of our new cloud technology back in September, and we're about to deploy phase 2. So we're really excited, and it's working well.
You mentioned AI. How much of a component is that of that strategy as well?
We haven't hired any AI components yet. We're doing our due diligence on a lot of it, and I think it'll probably be a cornucopia of solutions. I don't think there'll just be one.
Talk about hiring on that. Is this going to be a third-party firm, or you're hiring internally?
I think both. I think you need to have both. I think you need to have a third party that'll constantly be rejuvenating the technology itself, right? But then I think you need to have some internal folks that also maintain it and are sort of those goalkeepers a little bit on what you're using and making sure it's deployed internally with our systems.
As you deploy that technology strategy overall, including AI, where does the benefit of that lie? Is it primarily within Guggenheim, or is there more of a shared benefit with the actual end clients themselves, meaning the end investors?
Well, first it has to be internally, right, to allow us to make more timely investment recommendations and decisions. I also think it'll help with, since we're predominantly a fixed income shop and, we invest heavily in structured credit, securitized credit, private credit, bank loans. I think it'll really help with the covenant analysis, issuer analysis, all of our due diligence. And then after we feel really confident with it, we will obviously see if there's opportunities to share all of that with our clients.
And that was Guggenheim Investments co-president Dina DiLorenzo speaking with our Romaine Bostic. They were at the Greenwich Economic Forum in Miami earlier today. And while they were talking, Alex, I was looking at markets, and we have the major indexes at session lows. I mean, certainly the Dow, the S&P, and the Nasdaq are in the red by less than 1%. You look at the Russell 2000 off by 2.5%. The economic data has not been encouraging, certainly today. But one stock that really got my attention is U.S. Steel. It's down for a fifth straight day, losing 9% today.
Yeah, so that's all the drama about who's going to buy it, who's going to own it. So technically, U.S. Steel could operate on its own. It'd be fine. But you had Cleveland Cliffs making a bid, and then that kind of got the market interested. The Nippon Steel came in from Japan and made its own bid that was much higher.
Yeah.
And they went with that one. But the issue is, that I've learned, is that United Steelworker Union doesn't like the Nippon deal. They like the Cleveland Cliffs deal. And you can make an argument that in Pennsylvania, in an election year with unions upset, henceforth, the administration might not be as happy for Nippon to buy U.S. Steel as it might have been, say, 2 years ago.
It's as if President Joe Biden had heard what you said and did just that, because he has come out against the deal. He's voiced some concern about it. We know that the Prime Minister of Japan will be visiting the White House in April, so there'll probably be some more formal comments around that time. And now, as a result, Cleveland Cliffs has come back in and said, you know what? We might be willing to consider another bid for U.S. Steel if this deal with Nippon Steel falls apart. And if so, if it comes to that, we would consider something in the $30 range.
Right. So they were already bidding much less than the $55 a share that Nippon Steel was going for, but nonetheless a lowball offer. And I was asking Richard Burke, who covers for Bloomberg Intelligence, and I was like, but if they can go it alone, like, can't they just stay independent and say no thanks, but thanks? But I guess now shareholders are like, yeah, okay, cool.
Yeah, they're amped up for it.
In the zeitgeist, but definitely watching that stock as well.
All right. Another story that we're keeping an eye on, of course, is what's happening with TikTok. Will it get tied up in the Senate? Looks like it is. The House, of course, overwhelmingly passed a bill that would ban TikTok. But this proposed legislation, of course, faces an uncertain future in Congress's higher chamber. We're going to have more on this after the break. This is The Close.
We've heard a number of complaints from the government here in Beijing this week about the American debate on TikTok. I find it supremely ironic because government officials here are using the X platform to criticize the United States. They don't give their own citizens the right to use X, to use Instagram, to use Facebook, to have access to Google. And so it is ironic indeed that the government here is complaining about a process when they shut down access for 1.4 billion Chinese to all of these platforms.
That was U.S. Ambassador to China, Nicholas Burns, hitting back against Beijing's objection on the potential ban on TikTok in the U.S. Remember, the House did pass the bill to divest or ban, and the fate of that app, used by 170 million Americans, is now in the hands of 100 senators. The question we want to try and tackle is, if TikTok magically disappears, what happens to the advertising money that is poured in to that app? Joining us now from D.C. is Sensortower VP of Research and Insights, Seema Shah. Seema, let's take a step back for a sec.
Yeah.
How much ad revenue does TikTok actually make?
Well, so we can't see their revenue. What our data shows is the ad spend on the platform. So we estimate it's a little over $5 billion in 2023. But that's not necessarily their revenue. That's just the advertisers that we are able to see what they're spending on the platform itself. And if we look at our entire set of channels of advertising that we have in the US, that makes up about 5% of advertising spend in the US. And if you want to think about their biggest competitors, Facebook and Instagram, they're at, 20%, 19%, 20, 25 and 19%. So significantly higher than TikTok. But we're seeing rapid growth in TikTok advertising because of its younger demographic that it targets. So more and more advertisers want to be on TikTok. And as we discussed yesterday, Alex, the increasing popularity of short form video is driving that growth. And that's why you see Instagram Reels becoming popular and why Google's Shorts are also becoming popular, because it's that short form video.
So this legislative action really took TikTok by surprise. I mean, they're kind of lobbying now, but they're kind of making up for some lost time. When it comes to companies and how they allocate their budgets, ad budgets obviously take some time to redirect. But if they were to move right away, how long before that money is redirected?
If they were going to move right away, and assuming they kept the same proportion of offline and online advertising that they have currently, it's likely that all the TikTok, a huge percentage of the TikTok advertising would go to Instagram and then to Google. And particularly, as I was saying the other day, we have seen that 42% of user spend, 42% of time that users spend on Instagram is on the Reels portion. Similarly, users are spending the most amount of time on Google Shorts. So within the advertising space, I think you would see an increase in ads within Instagram and YouTube, and then specifically on the app towards the Reels portion of the app and the Shorts portion of the app.
Would that take place, in 3 months' time, in 6 months' time? How long does it take for them to move that?
I think with digital advertising or anything digital, it's very rapid. If for some reason it was passed tomorrow, I know there is some leeway of about a few months for TikTok to see what they're going to do if they're able to sell the company. So there would be time for advertisers to figure out their strategy, but in essence, it could be very quick.
So
if it had to be.
My family and I are doing this thing where we're trying to record all of our screen time every day for like a month to then sort of look at it as holistically and then get an idea of like what we want that number to be to kind of reduce it. So give me some stats, like how many hours are people spending or minutes are people spending on, say, Instagram versus YouTube versus TikTok?
Yeah, so one of the numbers I threw out yesterday was that 350 million hours per day worldwide are spent on short form video. 150 million hours per day are on social media, and 15 million hours per day are on streaming apps. So within TikTok itself, users spend on a global basis 78 minutes per day on the app, and that compares to 48 and about 28 for Instagram and Facebook, respectively. So it's a lot of time, and that's what makes TikTok so valuable, is how engaged its users are. And Instagram also has a very engaged user, and they have a user that opens the app very frequently, as does TikTok. But the amount of time they spend, if you're an advertiser, where are you going to put your money where people would definitely see the ads? And that would be why TikTok is so valuable. So
if the U.S. were to ban TikTok or force a divestment, it's actually happened before in India. Granted, this was before 2020, before TikTok really took off. What do we know from what happened in India, and how much of that do you think is applicable to what could happen in the U.S.?
I think that India is a good example just because that demographic is it's much larger. It's a younger population, so really like in the sweet spot of where TikTok was. In 2020, before the ban, they had about 150 million users in India, and that was about 20% of all of their global users. Wow. So when it hit, they basically immediately within the next year saw a significant drop, obviously, in their active users, and the biggest gainers was Instagram in terms of active users. They saw that their penetration amongst all the different channels of active users went up 30 percentage points in India, and Google also saw an increase on YouTube of about 3 percentage points, but that's off an extremely large base. So this is a huge number of users that shifted over to Instagram and YouTube. And also that was when a couple of local apps, social media apps, took off at the same time. And they did very well within those first few years. And they're still relatively large because TikTok was gone.
Hey, Seema, great stuff. We have to leave it there, unfortunately, but thank you so much. That was really great. Seema Shah of Sensortower. Great analysis. 78 minutes a day. Whew, mind-blowing. All right, coming up, we're going to count you down to the close with Venu Krishna, head of U.S. equity strategy at Barclays. This is Bloomberg.
This is the countdown to the close. I'm Scarlett Fu alongside Alex Steele, and we are looking at equities down, fractionally off by 0.5% for the S&P 500. But if you look at yields, they're up every single day this week.
Yeah, it's been a pretty monster move in the bond market. Overall, you're looking at Russell down over 2%, right? So really underperforming as you have this rally staying, the sell-off staying a little bit sticky, and I use sell-off and sticky in definite quotations because the volume is still a little bit mixed. But the energy sector is still the outperformer within the S&P, hanging on to those gains because oil prices are up for 2 days, up 5% in 2 days. The S&P energy sector up 2.5% in 2 days. That doesn't feel like an economy that's going to roll off. That's a geopolitical story, and that's also a global demand story. That's not terrible.
And it also raises concerns about commodities prices being another source of inflationary pressure.
That's right. I mean, yeah, we're going to look through it, blah, blah, blah. But it means it's not a disinflationary factor.
Right.
Like, that's another situation.
And of course, you add that with the PPI report that came a little hotter than anticipated. Where does that leave us? Well, when it comes to equities, it's no secret that the Magnificent Seven that have pushed the market to new heights continues to power on. But their rise has renewed warnings of bubble risk. We spoke earlier with Jimmy Chang. He's the CIO of Rockefeller Global Family Office. To give us his take, here's what he said.
Pockets of the sector feels bubbly. The issue is whether we call it a bubble or not. It's not a timing indicator. It probably means in the long run, it's not going to work out too well for many of the stocks. In the short run, are we in, January 2000 era or June 99, or are we close to that March 2000 peak? If you use the dot-com bubble as an analogy, you just don't know.
All right, for more market analysis, let's welcome Venu Krishna. He is head of U.S. equity strategy over at Barclays, recently publishing a big note on tech stocks, the Magnificent Seven. Venu, what's your take? Are we looking more like June 99, or January 2000, or is that not the right comparison here?
Everybody's talking about it, that whether it's a bubble, that's what the gentleman earlier was suggesting. But we kind of disagree. I think they are fundamentally different episodes. So the similarity is the fact that market was also very concentrated, led by tech. But remember, that was the internet exuberance. Business models were still in flux. They were unprofitable. And multiples had reached well over 70 times. Now you turn the clock forward now. We are at a stage where technology cycles, we had multiple cycles. It's matured a lot. Companies are highly profitable. The quality of earnings is very high as well. And the multiples are about 28 times forward earnings, which, by the way, was trading at 37 times just a few months ago. I would say after the COVID, right? So the question is that we are in a fundamentally different environment where you have two tech overlaps. So you're in the middle of a cloud transition phase. Yeah. And on top of that, now you have the AI transition as well. It's coming at a time when the background, whether it's the advances in computing or storage or the penetration of social media or of data in general, it's a more fertile landscape for that to take hold. Going forward.
So it sounds constructive, but then I look at your target for 2024 for the S&P is 4,800. So do you need to revise that up, or do you expect things to really fall off a cliff?
Well, we actually revised it, so that's a little dated.
Oh,
so,
okay. Well,
yeah.
It hasn't updated our strategy table.
Yeah.
Okay.
So we raised it to 5,300 just recently.
So that's better.
Yeah, and that's slightly better.
So you don't feel like you're chasing the rally at this point. You do feel like there's fundamental reasons.
So we are still in the camp that returns are going to moderate after a pretty significant return year last year. And by the way, last year you had the returns even when your earnings are effectively kind of flat, right? So, but that said, we are constructive, and we do at the same time feel that it almost feels like we are borrowing from future returns. So at some point, we wouldn't be surprised if you have some sort of consolidation or a breather, which is not necessarily bad. But if you look at the fundamental underpinnings, either at the economic level or at the equity level, especially the big tech stocks, I think we are very constructive.
Okay, so I know that you're a strategist, so you don't talk specific companies, but the Magnificent Seven feels like it's been unofficially downgraded to the Magnificent Six. Yep. Tesla is the only member out of those 7 names to have declined over the past year, losing 11% versus an 81% gain in the group overall. Do you see any other name, or are there other members of that group that are at risk for kind of falling out of favor in the same way, do you think?
Very interesting point you brought. So first, we've never included Tesla. When we talk about big tech, we talked about the other 6 stocks.
Really?
We always felt that Tesla was more of an auto/industrial sort of underpinning, though it has obviously a much more of a software bent. So from our perspective, when we talk about big tech, it was never a part of that.
Interesting.
That said, I think what our work is showing, interestingly, that while everybody thinks about big tech as a monolith, you can actually think of it as a microcosm of a tech-centric global economy. Right? And what I mean by that is there are a number of end markets which these companies serve. At the same time, there are a number of different end markets which each company separately also addresses. The net result is that they have a very broad set of end markets they're covering together. But if you look at correlations between the stock, it's not that elevated. And if you look at the correlation of these stocks with the rest of S&P, it's actually very low, right? So what that tells you is that, as you're suggesting, while the group has done very well, and we think as a group we are very constructive, within that there's a room for a lot of nuanced moves.
Yeah.
For example, yeah, go ahead.
I was going to say, Apple is a perfect example, right?
Yeah.
Where like it's still in the Mag 7 accounts,
Yeah.
but that China exposure has just really hurt it. It's not getting beaten up as much as Tesla, but over the last year it hasn't really done much. Is that the kind of thing you're talking about?
Exactly. So if I look at what our fundamental analysts are talking about, so we have 4 different fundamental analysts at Barclays who cover these 6 stocks, right? So if I broadly think about it, they are quite constructive on Microsoft, on Meta, on Amazon, and NVIDIA. Then I think as far as Google is concerned, they're constructive, but I think the second half is going to be somewhat more challenging from a comps perspective. And Apple, to your point, our analyst has been he's been negative for a while now, for a bunch of host of different reasons. But at some point, Apple is going to have its next iPhone cycle, and people are waiting for it to show more of progress on the AI front. They certainly have the underpinnings of a business to do something significant in their businesses. So it's a wait and see. But the point is, it is a highly profitable company.
Yes,
right? Yeah.
absolutely.
Yeah.
Perhaps just not growing at the rates that people were accustomed to
Right.
over the last couple of years.
Right.
Venu, really appreciate your joining us today.
Thank you.
Thank you so much for coming in. Venu
Thank you.
Krishna, head of U.S. equity strategy over at Barclays. I love the fact that he always saw the big tech as ex-Tesla.
Right.
Magnificent Six, in other words.
Well, that is kind of interesting. And if you look at it, it does feel like Tesla and Apple in some ways, they're both product-oriented markets, and they both have China exposure. Not that the other guys have no China exposure, but like there is some weird similarity there.
Product versus services, goods versus services.
Yeah, and also just the China thing. Like, is Apple in essence a China play right now?
Yeah, it always has been. It's certainly when it's going
hard to buy
up.
at that point.
All right, let's get you coverage of the closing bell. We have full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We are about 2 minutes away from the end of the trading day on this Thursday. Scarlett Fu and Alex Steele here with you. We're counting you down to the closing bell, and we're bringing in our friends in the radio booth to take you beyond the bell. Carol Masser and Tim Stenovic. Hey, guys.
We are friends.
We are friends.
I'm looking at that was not a, do that again, because that was.
Do you know my daughter always makes fun? She's like,
you know what?
Mom, what is
that? Was like a circle. She's like, we're friends.
Carol, you can't see it on radio. It's okay.
Okay, on radio it was
we are simulcasting
perfect.
streaming.
On
so it's
radio
okay.
it was perfect, by the way. What an interesting day, guys. So inflation's still an issue. I keep thinking about the moves that we've seen along the U.S. Treasury yield curve. Kind of back up, looking at that 10-year, at 4.29. That's pretty significant, a move up, and I feel like we continue to kind of hit that bar when it comes to that 10-year.
Okay, so a risk-off day also includes what's going on in cryptocurrencies today. I do have to hit Bitcoin because I've talked about it so much over the last week or so. As of yesterday, we had 4 days of records in 6 trading days. Today, certainly an exception. Bitcoin down 5.35% as we speak. Maybe it's just all risk off. It can't go up forever, right?
It's interesting that we've seen yields move up every single day this week, and equities have held up a little bit better. There was a day or two where they did gain, but for the most part, even today's declines are fairly contained.
Yeah, and I just really wonder, when that actually changes. At some point, you get a big enough move, maybe it's the 2-year at 5%, but we are a long way away from that. But is there a moment where we kind of roll over a little bit? Oh, there we have the bells. All right, so we are definitely off the lows of the session. The S&P down by about just 0.3%. Volume did pick up a little bit in the last half hour of trading, so it was definitely a little bit of the quote-unquote buy the dip, but we're still negative, but off the lows, Carol.
Yeah, and you know what? It's interesting looking at the market. What really took it in a big way was the small cap universe. Russell 2000, Scarlett, down about 2% in today's trade.
Yeah, pretty decisive move lower, even as the major indexes, including the Russell, did come off their lows in the last 30 minutes of trade. Let's take a look at the IMAP, which shows which sectors led the declines, which bucked the decline. And let's start with the gainers here. Not a whole lot of them. Two sectors in the green: energy up 1.1% as oil prices climb, and communication services gaining 0.6% thanks to Alphabet. On the downside, take your pick. REITs are off by 1.6%. I believe all 31 members fell. Utilities, also very interest rate sensitive, down by 0.9%, and consumer staples losing 0.8%.
All right, good to know. Hey, let's get to some of the individual gainers. Kind of hard, especially to find kind of fundamental reasons why some of the names were moving. But Alphabet, that was your third biggest gainer in the S&P 500, also top gainer in the NASDAQ 100. I didn't really find any specific news. It would finish the day up about 2.5%. I will say one story: their autonomous driving unit Waymo apparently announcing plans to offer public driverless rides in Austin, Texas later this year. Of course, home to Tesla, so maybe a little bit of a battle there, but shares of Alphabet, again, up 2.5% in today's session. Dick's Sporting Goods, though, this was definitely an outlier to the upside, up about 16%, almost 16%, so just off its highs of the day, rallying as analysts say the retailer's better than expected quarterly results and a potentially conservative guidance shows consumer demand remains. So that one definitely performing to the upside in the Thursday trade. And then this one, I actually had a call to check on the pronunciation. Impinge. Ticker is Pi. I'm kind of doing it in courtesy of Pi Day.
Oh, smart.
Kind of
I
my
like
gift
this.
to you. Thank you.
Do we think that's why the stock rose?
No.
It could literally be that, though.
No, there's actually some fundamental news. Listen
Okay.
to this, though. It was up 16% at its highs today, finishing the day just under a gain of 10% here. It's based in Seattle. It's a semi-device company, about $3.3 billion market cap. Company said it settled its patent disputes with NXP Semiconductors, with Impinge to get $45 million, a one-time payment from NXP. So, yeah, definitely moving to the upside. Stocks up something like 40%, I think, so far.
Happy Pi Day to
this year.
Impinge.
Yeah, exactly. Happy Pi Day. Nicely done.
Yeah, I want to get to some of the decliners on the day. I do want to check in on shares of Tesla because they're trading right now at their lowest level going all the way back to May of last year. Shares falling today by more than 4%. The catalyst yesterday was a report from a bank that said it was not going to be a growth stock anymore. And another day and another report from a bank coming out and saying, well, we're going to actually change the price target on the company's stock. This time it's UBS, and they're changing the stock, the target price to $165 from $225, so a pretty significant cut there. They also cut their 2024 delivery estimate to 1.96 million from 2.02 million. And check out shares of Under Armour. Some news broke after the bell closed yesterday that said that the company is announcing the return of Kevin Blank as the CEO, replacing Stephanie Linnartz, who was in the role for just over a year. Also, some other management changes include Mohamed El-Arian coming on as the company's chair of the board. Shares closing down by 10.8% today. Shares were down an 11th straight day. It's the longest losing streak going all the way back to November of 2016. And let's check in on shares of Fisker. The electric vehicle startup fell by more than 50% today in post-market trading yesterday. That held today for today's open session after the Wall Street Journal reported that the company has hired advisors to assist with a possible bankruptcy filing. And then an honorable mention in the decliners today.
Isn't it a 15-cent stock?
Fisker?
Yeah.
15-cent stock. Yeah, exactly.
You read that correctly.
That is a
Okay, I
serious
was like-
strong
I don't know if I'm seeing that correctly. Do you want to mention WW International, the company formerly known as Weight Watchers? Shares plunging to their lowest level on record, another 20% decline today, trading at just a shy of $1.90 right now. This comes after 9fin reported, citing unidentified people, that lenders for Weight Watchers International have hired Gibson Dunn as it prepares debt talks. It's down nearly 80% so far this year. Since its 2018 highs, Shares have shed more than 98%.
So for
The
$2,
Ozempic effect.
so for
That's what Carol was
$2.05, you
talking
can buy
about
a
earlier,
share
yeah.
of WW International and Fisker. $2.05.
It's not
a
only
share each.
the Ozempic. It's the Oprah lack. It's
But
the
Oprah is linked to Ozempic.
Yes,
Yeah.
but that idea. But guys, I got to be honest. You can talk about the declines all you want, but the big mover to me is in the bond market. You have 10-year yields up by 10 basis points, and it's also important because it broke through some key technical levels. So we're now extended above all the moving averages for the 10 years. So you have to wonder if there's going to be position reshuffling into tomorrow as well. And we've seen a really solid move in yields this week, and equity is doing all right.
Yeah, absolutely. Hey, folks, we are still having a little bit of earnings coming out. Adobe just crossing the Bloomberg terminal. I'm going to go right to one headline that catches my attention. Adobe announcing a $25 billion share buyback.
Wow.
Okay.
Yeah, Wawa is right. Right now, the stock goes down about 6%. The outlook from the company, seeing second quarter adjusted EPS, $4.35 a share to $4.40. The estimate out there is $4.38. Look backward, the first quarter adjusted EPS, $4.48. That's 10 cents better than the street was forecasting. First quarter revenue, $5.18 billion versus the estimate of $5.14 billion. Stock still down about 2%, 3%. So interesting to see kind of this negative reaction, especially after that $25 billion share buyback.
Yeah, Dan Dern, the company's executive vice president and CFO, said that the $25 billion share repurchase program demonstrates Adobe's continued commitment to returning capital to our shareholders. The company's CEO saying that Adobe's done an incredible job harnessing the power of generative AI to deliver groundbreaking innovation across our product portfolio. Have you guys seen the way that Adobe is using AI in its suite of products?
I've seen the commercial, and it's very impressive.
It is really impressive, and it's very easy to do. Like, I have friends who don't even know how to do this stuff that are actually able to do this.
And I think that's the key there, right? Because for people who don't use Adobe frequently and just use the free version of it, if you can hook us, then we'll start paying for it.
Right.
But that $25 billion share buyback is so notable because, of course, Adobe did not go forward with its purchase of Figma, which would have cost $20 billion because of regulatory issues. So the big question mark was how it was going to spend it. Would it look into another purchase? I mean, that was not really in the cards, but to put it all in a buyback, interesting.
You know, I just want to point out that the second quarter revenue outlook maybe is what is dragging the stock a bit lower. So they see up to $5.3 billion. The estimate was for 5.31, so a little bit light on that. I just want to touch on Ulta for a second. It's a flip side story. That stock up about 6%. They have a $2 billion buyback, and they see pretty strong sales for the year. Comp sales better than estimated, earnings better than estimated, and sales better than estimated. Invest in your face, guys. That's the takeaway from Ulta.
Hey, you're preaching to the choir, honey. You're preaching to the
girl,
choir.
I hear you.
Hey, you know, it's interesting, though. Ulta is up about 15% year to date. I think it hit a 52-week high in today's session. So, yeah, this one up about 4%. So just building on that gains, right? It's like, yeah, you got to, Tim, you invest in your face.
Yeah, of course.
I think our jobs depend on our
Who doesn't have a routine?
That's what I keep saying.
Who doesn't have a routine in this day and age?
Yeah,
right?
My husband just started using face cream, and when he does it, it gets me so stressed because I'm like, will you just calm your face? Like, just pat, just don't. It hurts. It hurts. It doesn't use soap. It's a whole thing.
All right, it's a whole thing. All right. A tale of two earnings. Ulta up about 2.5% in the aftermarket. Adobe still under pressure. I think you hit it right on the nose, Alex, in terms of that revenue forecast. It's down almost 7% in the aftermarket. All right, that's a wrap. Across platform, yes, face. It matters, like the protection, the uses. That's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals, folks. We'll see you again, same time, same place tomorrow.
All right, coming up, we will continue to dive deeper into the earnings that were released after the close. Adobe shares moving down in the after-hours trade as it gives a forecast that misses the average analyst estimate. This is The Close on Bloomberg. All right, Adobe reported results in just the last couple of minutes, and the stock is moving lower in after-hours trading after the software company gave a forecast for this quarter for sales that missed the average analyst estimate. It sees revenue of anywhere from $5.25 billion to $5.3 billion, when analysts on average were looking for $5.31 billion. The stock, as I mentioned, losing ground rapidly in after-hours trading. In addition, it announced a $25 billion share buyback. Let's bring in now Parker Lane. He is Associate VP of Technology over at Stifel, and Parker has a buy recommendation on Adobe with a $650 price target. So Parker, when it comes to that second quarter revenue forecast, is this something where the bar kept going up over the last couple of weeks and Adobe just couldn't meet it?
Yeah, if you look at the expectations around the digital media segment for Adobe at 440 of net new ARR versus 470, I think investors, similar to last quarter, are hearing a lot of great things from the company on the AI front, hearing about increased adoption, and are simply waiting for that to actually reflect itself in the fundamentals here. So a very similar outcome to last quarter when management said, we feel really good about AI, but it's not that meaningful uptick in our fundamentals yet. So I think it's a similar reaction to what we saw last go around.
And I know that Adobe management's job is not necessarily to manage the stock price reaction, but is there a communication issue here then if investors are believing one thing, but management is telling them something else that kind of, forces them to press on the brakes?
I think we're so early on in the monetization journey of generative AI and enterprise software that there isn't a reasonable expectation that companies would have a 100% grasp on that yet. I think, this stock, you look at the way it's traded so far this year, you've got announcements from OpenAI with its Sora product that are driving Adobe shares down. In the meantime, you're seeing a lot of great development on Adobe's part. So I think there's a bit of a disconnect between expectations and reality right now, and hope to get that sorted out on the call.
Okay, got it. In terms of use of cash, we know that Adobe did not move forward with that $20 billion purchase of Figma, and now it has announced this share buyback program of $25 billion. From where you sit, is that the best and most appropriate use of that cash?
I think it is. There was an expectation that, given the regulatory concerns around Figma, there isn't a natural acquisition target for Adobe right now. You can't really go by Canva and simply tuck in. So I think this is what the shareholders are ultimately going to like. You'd probably like to see continued investments in generative AI features as well, but I think that they're in a good spot with the R&D budget that they have today.
So looking ahead to the call, how much of the call is going to be focused on this Adobe Summit user event later this month and the AI assistant that they're going to roll out there to get people excited about the next catalyst?
I think it's hugely important to the stock as well. Text to video is an area that Adobe hasn't really outlined a lot of plans or actual product around right now. Last year, if you go back to this Summit event, that's when they first launched Firefly, and that really set the shares in motion for the really strong performance over the last 12 months. So I think investors will be attuned to exactly what the company's saying around that, and maybe it can ease some of those competitive concerns.
Yeah, it's seen as the next AI innovation cycle for Adobe. Parker, really appreciate your joining us today. Parker Lane of Stifel with the latest on Adobe, which is falling in the after-hours trade. Let's stay with technology, but focus really on startups here and the outlook for VC funding in the year ahead. Earlier today at the Greenwich Economic Forum in Miami, Romain Bostic spoke with Ken Cancel, CEO of Churchill Asset Management. What they did was discuss the role of private credit in driving deal-making.
And what we've seen is private credit, direct lending, fill the void. Mm-hmm. And that has been incredibly important from my standpoint, from an economic standpoint, to see companies that needed financing and deals get done, and obviously the growth continues. So I think it's been a good thing overall.
Private credit as a source of funding. What about startups? For more insight, let's bring in Jewel Burks-Solomon. Jewel is the managing partner at Collab Capital, which has a portfolio of 35 startup companies focusing on Black founders, investors, and industry professionals. Jewel, it's so good to speak with you.
Thank you so much for having me.
So I guess I want to start big picture here because it's kind of hard to characterize where the economy is right now. It's more resilient than expected, but we see inflation proving to be sticky, and therefore consumers are starting to slow down their spending. From where you sit, could you describe the current appetite for VC investing in startups, and especially those founded by underrepresented minorities?
Sure. So it's a challenging time right now. We are seeing a few things happening all at once. So 2020, 2021, people were really excited about VC, and a lot of allocators are somewhat overweighted and somewhat over-allocated in the VC market. So fast forward to where we are now in 24, we're seeing that folks are waiting on liquidity. Obviously, we haven't seen as many IPOs as we would expect. And so we are in a challenge from the seat that I'm in as a VC manager, we're waiting on some of those liquidations to happen so that LPs can start to put more money into VC.
So there's a little bit of a logjam at the moment here.
Yes.
There's also political backlash to DEI. We see companies moving away from programs focused on recruiting and investing in women and underrepresented minorities. What's the effect on your firm? Are there more founders pitching to you as a result?
Yes, there are. We've been steadfast in our approach, investing in Black-led innovation companies, and we do see that there are many companies that are pulling back and wanting to, take that language off their website and really shift their strategy. But for us, it's really important because even though DEI has become politicized, we know that the reality that these founders are building incredible companies still exists, and the political sphere shouldn't shift their ability to access capital. And so we're remaining, in our square of investing in this way, and not worrying so much about what's happening on the legal challenge and in the political sphere.
Any material effect on your fundraising for the Collab Fund 2?
I think what it's doing is it's helping us find more aligned investors, the folks that weren't as focused and as dedicated for the long haul for DEI. Those are not going to be our partners, but we are finding people who really want to be a part of this work for the long haul, and we're finding them, and they're committing to our fund.
We were talking earlier about Adobe and AI, so I want to bring in AI to this conversation. Collab Capital has brought in an AI executive in residence. What kind of pressure do you see startup founders facing to incorporate AI into their business model when maybe it wasn't there originally?
Sure, it's a lot of pressure because we are seeing that it's required at this point for companies to understand how is AI going to impact their business, and are they going to be victim or victor when it comes to AI.
Good way of putting
it. We're seeing across the board for all of our portfolio companies, working with them, figuring out how to incorporate AI into their core product, into their business models, into their ability to efficiently put out product. And yes, we brought on Dr. Nashley Cephas, who's been an AI leader at Amazon for many years, to join our team to help us work on the strategy for all of our portfolio companies.
Are there any early stage investment trends with absolutely zero links to AI that are getting attention and getting dollars?
I think everything has a link to AI these days, but what we're seeing is that we focused on what we call consequential problems. So really focusing on making sure that at the end of the day, the businesses that we invest in are solving real problems. And we see that across the board. We have companies like Culina Health, which is focusing on getting your everyday consumer access to a dietitian to help them with their health concerns. They're incorporating AI, but they're still focused on solving a fundamental problem. Right. Same with Options MD, which is focused on treatment-resistant depression and how do you get care for folks that are dealing with that.
So when they incorporate AI, as you put it, are they having to completely rethink their strategy as a result, like rip it up and start all over again?
No, absolutely not. These companies were already on cutting edge technology, and it's really a matter of how do you layer on top of what we were already building to incorporate the latest and greatest from a generative AI perspective.
All right, fantastic stuff. Thank you so much.
Thank you.
I've been speaking with Jewel Burks Solomon. She's a managing partner at Collab Capital. Again, we mentioned AI. Let's just go back to Adobe for a moment here because the stock continues to move in after hours trade, lower now by more than 10%. This is after its revenue forecast for this quarter came in lighter than anticipated. Perhaps investors got overexcited about the extent of the monetization of AI, and it hasn't really come through just yet. Of course, we're going to get more details on the earnings call, which will begin in the next hour or so. Also, Adobe coming out with a $25 billion share buyback authorization. Coming up, we're going to give you the top three. We focus in on the top three movers and shakers at the center of the day's biggest stories. We'll discuss that next. This is The Close. It is time now for the top three, where we cover the folks at the center of the day's most talked about stories. And first up is Steve Mnuchin, the former U.S. Treasury Secretary, wants to buy TikTok, saying he's already spoken to potential co-investors. He told CNBC that TikTok should be owned by a U.S. business. The House yesterday passed a bill that would either ban the social media app or force China's ByteDance to divest it. Next up is Adam Neumann, making big plans. The WeWork co-founder has a new startup that's planning $300 million of developments in Miami, including rental apartments, retail space, and small offices. And that's not it, because as we've been reporting, Neumann is still exploring a joint bid with other investors to buy back WeWork after he was ousted and the company then filed for bankruptcy. And finally, Shohei Ohtani, who is headed to Seoul with his new team, the LA Dodgers, for their regular season opener against the San Diego Padres. Now, tickets for next week's game selling for more than $3,000 each on the secondary market. That is 5 times the face value. In addition, turns out whoever buys the ticket will have to watch the game sitting next to the scalper that they bought it from, because they don't want to give up everything either. All right, we're going to stick with sports here because the latest episode of The Deal with Alex Rodriguez and our Jason Kelly is now out. Jason and Alex sat down with a Smack Entertainment CEO, Constance Schwartz-Morini, to talk about Michael Strahan's transition from the football field to the television screen. Take a listen.
When Strahan went into the Pro Football Hall of Fame, when you get that, you go back to your team and they present you, with the team and you get a ring. And I was on the field when he was being honored and all the giant sponsors were there. And a wife of a big sponsor overheard her. She goes, "Why is Michael Strahan from Live with Michael and Kelly being honored at the Giants game?" And everyone looked at me like they thought I was going to be upset. And I started high-fiving my team. I was like, my God, guys, we've done this. In these short years, in 6 years, we've crossed him over, from being a retired athlete to a media powerhouse.
So Jason Kelly, co-host of The Deal, joins us now. Constance sounds like one of those people who are the movers and shakers behind the scenes. You never know about them, but they're the people who make it happen.
Totally. She's a fascinating character, Scar, because if you think about these athletes and entertainers who have, as our colleague Tom Keene would say, in the zeitgeist, that's where they are. You think about Michael Strahan, you think about Coach Prime. I mean, she has been the architect, Snoop Dogg, these people who have just elevated into something bigger than what they started out doing.
So it's crossover appeal and making sure that they kind of touch different corners or different aspects of pop culture. Who else does she work with? What's another example?
So Erin Andrews is one of my favorite examples. This is a woman who's really,
the ESPN sportscaster.
Exactly. And so one of the things that she and Constance worked on was this apparel line called Wear by Erin Andrews. Mm-hmm. It's done very well. It's like an affordable type of affordable and premium all at the same time. And one of the things that they make is sports gear, team wear. And they were watching one of the football games during this fall. And it was one of the games that when Taylor Swift was showing up.
So the Kansas City Chiefs were playing.
Kansas City Chiefs were playing. Travis Kelce was on the field. Taylor Swift was in the box. And Taylor Swift was wearing a Wear by Erin Andrews. And as Con says in our episode, they went nuts because they knew what that meant for the brand. And sure enough, the exact thing that Taylor was wearing immediately sold out.
Wow, yeah, that is, that's not just the zeitgeist, that's being ground zero of
right,
the
exactly, the white hot center.
Absolutely. So she does this in a way where people go to her and they say, I want to break into this space, I want to break into that space, and she kind of comes up with a vision, a strategy?
Yeah, pretty much. I mean, she's a different sort of manager, a different sort of talent manager in that sense, because what she's looking at is who are the people who have the potential to be bigger than what they're doing. And so, Deion Sanders is, I think, a great example of this. If you think about, where he was an iconic football and baseball player, played for the Falcons and the Braves simultaneously, very famously. Primetime was his nickname. He stayed, very much in the general conversation, but she was the architect of really, getting him to be a coach.
And of course, the rest is history, right? Coach Prime. All right, Jason Kelly, thank you so much. Bloomberg's Jason Kelly, of course. You can check out that full episode tomorrow of The Deal at 7 p.m. Eastern on Bloomberg Television, or you can stream it tonight at 9 p.m. Eastern Time on Bloomberg Originals. It is The Deal with Alex Rodriguez and Jason Kelly. Now, still ahead on the close, we're going to talk to Nancy Watkins. She is principal and consulting actuary at Milliman about the insurance crisis in disaster-prone areas. This is an important story. It affects those living in California and Florida. This is The Close on Bloomberg. From wildfires burning in California to hurricanes sweeping across Florida, a growing number of private insurance firms are pulling coverage from states prone to natural disasters. And this is forcing states to absorb trillions of dollars in risk. It's all detailed in a Bloomberg Green series called Uncovered, which looks at how climate change has rendered vast swaths of the world uninsurable. Joining us now for more is Bloomberg climate reporter Leslie Kaufman. So, Leslie, insurance companies like State Farm have been cutting their business because it's uneconomical. The risks are simply too high, and they can't charge higher premiums because of government restrictions. They're not allowed to, essentially. So tell us what happens then, because there are these so-called last resort insurance programs that states have created.
Right. So this last resort insurance programs by the states were created decades ago mostly, and they were there to fill a very niche market. They were meant to serve people who couldn't get insurance elsewhere. And they were a good idea, except for climate change has changed insurance. And now people are pouring into these plans. California, in particular, says they're getting 2,000 calls in a day. Florida has $525 billion in exposure, the state-backed plan, and the state-backed plan in California now has over $300 billion. So the states have taken on this incredible risk. The question now is, are they financing it?
Right. And this is a big issue, and it's difficult to get an answer on it. When you say state-backed, by the way, are they owned by the state? Does that mean they're backed by the state if the losses get to a point where they can't fund it?
Well, so that's a little tricky. The states will tell you they don't own them. They're private corporations that have been set up by the state. But the question is, and they basically force insurers, private insurers in the state, to pick up part of these policies in a percentage of their market share, which means that essentially private insurers are being forced to insure the very properties that they wouldn't through their own market. So that's pretty scary to private insurers. So that's part of the reason they're pulling out of these states. So what happens when a big catastrophe comes along? I think the answer is no one knows right now, except for in a few states. Florida, for example, will put a fee on every insurance policy in the state. In other words, they'll spread the risk among all residents, whether or not you have a risky property or not.
Wait, so what you're saying is if there's a really, really big catastrophe and there's hundreds of $billions in claims and therefore the state-backed insurance plan can't cover it, then ordinary taxpayers will have to pony up extra fees to cover all of that?
Almost certainly, yes, depending on the state in different ways. In Florida, it's explicit. In other states, it's just an open question that no one knows the answer to, and no one seems to have asked. So I don't know which you find more scarier, knowing that the state will definitely tax you or not knowing what they will do when the catastrophe comes. But both are possibilities depending on where you live.
All right, Leslie Kaufman, thank you so much, raising some important questions here. So let's stay with this topic because we have research from Milliman, which has found that 36 of these last resort insurance plans, residual insurance plans across the U.S., of them, only 15 explicitly explain how they would pay off deficits. Joining us now with more is Nancy Watkins. She is a principal and consulting actuary in Milliman's San Francisco office, specializing in climate resilience and catastrophic property risk. The perfect person to speak with in this case. Nancy, I love the quote that you gave Leslie in her story. You called these last resort residual insurance plans a magic hiding place to disappear risk that just gets too big for the private market. Can you explain what you meant by that, a place to hide risk, to disappear risk?
Well, I was trying to illustrate a point. I don't think magic is written into law, but it's essentially the risk that the insurance market walks away from, creating a protection gap, gets picked up by these residual plans. And that is a social benefit. It's something that has functioned very, very well for many years. The problem is if the risk gets too big, in many states, as Leslie was mentioning, there is no provision for or no transparency for who ends up picking up the risk. So it's really the magic of subsidization, and subsidization in some dosage can be healthy, but if no one is budgeting and planning for that kind of future cost, it can cause problems down the road, which is, I was happy to see Leslie's article making the case that more information needs to be put out there about how this will work.
How come they're not budgeting or planning for this? Are they using outdated data that doesn't suggest there will be any big wildfires or big storms that could result in a lot of damage?
Well, I think the plans themselves are actually, they're charging premiums. In some cases, they're buying reinsurance. I mean, they have plans for how to pay normal amounts of claims. It's just that once the plans get too big and the risk gets very highly concentrated, one major event can come along and go over top of the plan's surplus and reinsurance, creating a deficit. What's not often budgeted for is who ends up paying in that case. As Leslie mentioned, for Florida citizens, that could be homeowners of non-citizens, or it could be people with auto policies or business owners policies. Those people are not budgeting for future risk assessments from citizens' policies. And in cases where there's no clear plan for whether the insurance industry can recoup the premiums from their policyholders, I don't think that there's a transparent way of saying what's the effect on homeowners in the area for future premiums.
Do you see any lawmakers or elected officials anywhere addressing the rising risk or trying to tackle some of these questions?
I do. The NAIC, National Association of Insurance Commissioners, has just put out a data call in combination with the Treasury Federal Insurance Office to find out historical, I think, 5-year history of premium increases and coverage decreases. I think that will illustrate some of the areas where there are more policies going into the residual markets. The government-sponsored enterprises, the federal housing associations are asking me and my colleagues a lot of questions about the insurance market, and they're trying to figure out, are they on the hook for these risks? If people start defaulting on their mortgages, if insurance goes away, if assessments start coming through people's insurance policies. So there are attempts. I think that's a good thing. I just don't think we're there yet.
Okay, so it's a work in progress, certainly. Can you give us some size and scale? I mean, how big a market share do these last resort insurance programs have right now? We know they've been steadily increasing their market share. We know that private insurers have been pulling out, but what's the latest in terms of their exposure to the overall market?
Let's see. I know that the total insured value almost doubled from 2013 to 2022. I don't know the market share of the residual markets in total. One thing I would say is, like in California, I think they're only about 3% market share, but in the 10 largest counties, the California Fair Plan has had over 22% market share a couple of years ago. And that was before some of the major pullouts. So you really would want to think not only about total market share, but concentration of the most cat-exposed areas.
Does anyone have any estimates on how big the losses could become if these last resort insurance plans don't have enough to cover the claims?
I'm aware of some plans. The North Carolina Beach Plan and Citizens do publish information about what they call their probable maximum losses and their reinsurance. They're modeling what are some of the worst case scenarios. Not all plans do that.
Okay, so stress testing is crucial here, and not just stress testing, but honest stress testing as opposed to, just let's get it over with as an exercise. Nancy, really appreciate your joining us. Nancy Watkins is principal and consulting actuary at Milliman. It's a fantastic story in the Bloomberg. I recommend you go to the website to check it out. In the meantime, let's take a look at how stocks closed on the day. Not just stocks, but markets overall. You had equities in the red. We had a hotter than expected PPI print, a cooler than expected retail sales print. Maybe some questions now about the possibility of stagflation. No one is saying that. It's just kind of in the air as a possibility. We saw yields move higher across the curve. There's a 10-year yield up 10 basis points. Remember, we have the FOMC meeting next Wednesday. And worth mentioning here as well, you have commodity prices moving higher by 2/3%. Could this be an inflationary impulse as we continue to look for inflation to come down to 2%? This is the big question. This is The Close on Bloomberg.
There's a housing shortage in the country right now. It is well documented. As interest rates has fluctuated up and down, the American consumer has found itself up against the wall of affordability. And that means that people are having a tougher time qualifying for a mortgage as monthly payments go up because of interest rates. They're having a more difficult time because of inflation, saving the amount of money they need for a down payment.
That was Stuart Miller. He is co-CEO of Lennar, the Homebuilder, speaking with us last hour. We're going to stick with housing here because our next guest says that inventory is finally starting to recover now that the effects of rate lock are weakening. Joining us now is Zillow's chief economist, Skylar Olson. So Skylar, can you tell us a little bit more about what you're seeing when it comes to rate lock, this idea that people don't want to give up their rock bottom mortgages of less than 3%?
Yeah, well, Zillow's been tracking for a while in our customer surveys, particularly of owners, an elevated share that expect to sell in the next 3 years. And the trick here is an elevated share that expect to sell and haven't been able to or haven't wanted to because of high mortgage rates that make, giving up that incredible financial advantage. The good news is that the data that we've been tracking for new listings from existing owners shows that we're finally starting to at least see some of those folks return to the market. New listings are up 20% from last year, which is a stunning number and very exciting. But we have to remember that last year was a particularly low year. So if we compare the level of new listings from existing owners right now, we're about 17% down from normal pre-pandemic, but that's a lot better than where we were. We had gotten at our worst 35% down in April of last year. So we're slowly starting to see those new listings come back, at least hit a new normal of kind of a higher rate of listings of owners kind of coming back to the market. Sales should follow.
What do you think is driving that increase in listings, over this past year? Is it because people see interest rates starting to fall at some point?
Yeah, I think it's a mixed bag. One, I think we can't discount just time, right? So an elevated share of sellers expecting to sell. I mean, they're going through major life events that are making them want to move, right? They're just putting it off because the financials don't line up. But then let's think of the other things that are happening right now. And I'm sure you're intimately aware as someone who participates, in the news on this topic. We're constantly pushing back the time where we expect mortgage rates to fall, right?
Yeah.
Seeing higher inflation numbers, job growth still persists. It's softer, but it persists. And so we're pushing back this moment where we expect rates for falling. If I've been putting off a move already, I may stop waiting just because the expectation has changed. So that's a part of it, because right now mortgage rates back up at 7%. We do see some more activity happening on the listing side when rates fall, but it's more the buyer that rushes in when rates drop. That seller, has just been persistently, just steadily getting used to it.
Yeah. Okay. I like that explanation of time because it's true. At some point, people just have to get on with their lives and they can't wait forever. I want to ask you about Florida because we have started to see more inventory come online in Florida. Is that a good window into what could happen in the other parts of the country, or is Florida kind of its own special situation?
Yeah, I mean, I think there's more going on in Florida than other areas of the country can account for. You guys just did a segment on, insurance costs, right? There could be more potential sellers that are motivated to sell because, their monthly payment is increasing. That property tax or that insurance is now something they no longer are wanting to hold on to. Other things are going on, though, that's shared between Florida and, say, Texas. These are both areas where new listings are closer back to normal. And these are also areas of the country where a larger share of the population is likely to hold a higher mortgage rate. So they are literally less locked in. And say, if I look at the Northeast, that's the other side of this picture. I mean, Philadelphia, New York, all the way up to Boston, those are very low levels of new listings increasing. They remain locked in. And those are some of the areas where we see some of the fastest home value growth still.
Okay, got it. What about the economics of renting? Because especially for the younger generation that has been looking to buy a home since the pandemic but hasn't been able to because there just isn't enough supply, they've had to put aside their cash and put it into rent, which to them feels like they're throwing away money. Has that eased up significantly?
The rental challenge, or rather the current pace of rent appreciation or rent inflation, has slowed down. But that's a big step function from where it was pre-pandemic. If I was to compare, say, a monthly payment that you might expect to pay if you go to become a new homeowner, face higher rates, face high home values, or if you go to become a new renter of a comparable unit, they're a little bit on par, but you might save actually a little bit on a monthly basis as a renter today. Over time, we do expect rent growth to return, so that homeowner who might have locked in a mortgage payment, and if they're not in an area where insurance payments are becoming a particular challenge or increasing, then they generally will experience better affordability over time. The dollars and cents of it between rent and buying is that buying still has advantages built into this, whether it's leverages or tax breaks, that makes it a good financial decision. But now for that first-time home buyer, it's a good financial decision the longer you stay. So now that rates are higher, if home value forecasts are softer, you'll break even in several years. So if that's what you're looking for in your next move, it's a good financial decision to buy. But for folks that are in younger stages of their life and moving, renting will still look better in some areas than buying, but that doesn't mean it looks easy.
Right. So we talk about the demand from this millennial generation, which is really large. What about the need to sell from the boomer generation? Because obviously they're a big chunk of the homeowner base. They own their homes outright. They don't pay a mortgage anymore. When do you expect to see that really come to fruition, a wave of sales from this generation?
Yeah, that wave, or the silver tsunami, as it has been coined in the past. Zillow did some research on this one, and if you just think of the demographic patterns that we're waiting for, you're still waiting for several years to happen in earnest. Because it's not, this is going to get morbid, it's not the retirements that we're really waiting for, because generally that population still goes to buy their next home as well.
Yes.
We are waiting for kind of more of the end of life dynamic that makes a boomer decide to rent their next home, is generally when they lose their partner. And that's in, that wave for that large generation is still in about 10 years, maybe a little less.
Okay, so the silver tsunami is a phenomenon to come in about a decade's time. Skylar, really appreciate your joining us and giving us the lay of the land here when it comes to housing and renting. Zillow's Skylar Olson joining us today. Now, still ahead on the close, what investors need to watch for tomorrow's trade. This is the close on Bloomberg. Let's look ahead to Friday's trade, and one big thing investors will be watching for tomorrow is triple witching. Let's bring in Abigail Doolittle for more. Triple witching, once upon a time it was quadruple witching.
Exactly.
But now triple witching.
It's now triple witching. It sounds a little bit spookier than I think it has to, because at the end of the day, it's just options expiration, which we have every third Friday of the month. I believe that's the case. But this is the one where we have all three: stock options, stock index futures, stock index options contracts. And that means a ton of securities changing hands. It happens March, June, September, December, lots of volatility and lots of volume. And we can see in this terminal chart here that those spikes on the bottom of the terminal chart, that's the volume. Sometimes it's double what it usually be. The one I remember the most, Scarlett, we can see all the way over to the left on the terminal chart. That is March of 2020. That was March 20th. That week, we saw stocks go down 15%. But then that was really the bottom. It acted as a reset. So sometimes these quadruple witchings, or excuse me, triple witchings, can also act as a bottom for a springboard to go higher.
Oh, interesting. Okay, so the activity could give us a signal about what's to come when it comes to price action.
Potentially, although in this case, since we've had the rally, maybe it could be a reset to the downside, especially given NVIDIA. Steve Sosnick of Interactive Brokers, who's going to be joining us for Options Insight tomorrow, he was saying that he thinks that the NVIDIA expiration could be super interesting.
Of course, NVIDIA, one of the Magnificent Seven, the best performing Magnificent Seven stock as well over the past year. Okay, so we've got triple witching coming up. That might introduce volume and potentially some volatility. What else is in the calendar?
Well, we do, of course, have the S&P 500 rebalancing. It will not be a dull day. We found out a couple weeks ago that it's going to be SMSCI, Supermicrocomputer, and Deckers coming in. It's going to be Whirlpool and Zions Bank Corp coming out. Now, the thing that stands out the most here is just SMCI. I mean, it's really been on fire, up more than 1,100% over the last year, having everything to do with the AI craze. And to put that into perspective, on this chart, SMCI is in orange. In white, that's NVIDIA, the stock that everybody thinks is up so much.
Wait.
Yes.
I'm looking at this. Is that right?
Yes.
1,184% in the past year?
Yes. That is how much people have wanted in on this AI craze. And the idea that you can barely see NVIDIA's gain, which in reality over the last year is 266%, that's how much people have wanted in. Now, what makes the rebalancing interesting, portfolio managers who balance to the indexes, they have to, of course, buy, sell these shares.
Yeah.
But SMCI, more buying, my gosh.
I know. I was looking at that chart, and it makes the S&P 500 look like it's been flat over the past year, and we know that hasn't been the case.
It's up 34%, which is very healthy for the index.
All right, Abigail Doolittle, thank you so much. And, of course, you'll be covering all of this tomorrow across the market trading day. Abigail Doolittle with a look at, of course, the index rebalancing as well as options expiration. Let's take a look at what else we're going to look forward to tomorrow. After the market opens, 30 minutes after the open, we get University of Michigan consumer sentiment surveys. Of course, there's going to be the current conditions and also the outlook in terms of what investors and consumers are anticipating. So that'll be a big data point, especially when we try to gauge sentiment towards what's been some pretty hot inflation numbers. Now, we have the S&P rebalancing, as Abigail was telling us. Deckers comes in. We also have Supermicrocomputer coming in, and Whirlpool and Zions Bancorp will be going out. So look for those stocks to move as a result, as index funds are forced to buy the new entrants and forced to sell those that are getting kicked out of the index. And all weekend, we have the Russian presidential election. It runs from the 15th through the 17th. Vladimir Putin, pictured here, of course, is one of the contenders. He's expected to win his 5th term. If he doesn't, that would be breaking news. But again, he is expected to win. That does it for us. Balance of Power is up next. This is The Close. Have a great evening.